Mr. Yusko, welcome. Good to have you with us.
Hey, Tyler.
What right now is the liquidity risk, and why are you focused on it?
Yeah, I think the biggest risk that the markets had past tense, been grappling with was the Fed withdrawing liquidity from the markets by raising rates. I'm thinking that's probably off the table now. Unlikely we're going to see much, if any, rate hikes over the course of the year. And part of that is the GDP growth numbers are collapsing, earnings estimates are collapsing, and I think people are coming to realization that the base effect of the lockdowns, kind of the recovery after the lockdowns, is really all that a lot of these big growth numbers were. So one of the things that I find really...
excuse me for interrupting, Mark, but are the liquidity risks rising or falling if the Fed is going to not put its foot on the brakes as harshly as many people say? So that would suggest that the liquidity risks are not as great as they might have been.
A great point, Tyler. Liquidity risks for equities, for equity investors, definitely are falling. When I talk about bigger liquidity risks, I'm talking about financial repression. You know, we've been in a state of continuous financial repression since the global financial crisis, artificially low interest rates, punishing savers at the expense of profligate spenders. And I think that's about to continue. And for us, one of the biggest challenges for investors is you put your money in something safe, cash, money market, bank account, CD. You're making zero, literally close to zero. After inflation, you're losing 7% of your money. That's why we actually launched an ETF recently called CSH to try to address some of that by using arbitrage to get some return to people at the savers.
Yeah, it's always a tricky thing to get people a return on their cash without exposing them to too much risk in order to generate the returns on that cash. So where would you then, Mark, be hunting around the market for opportunity?
Yeah, I mean, look today, right? There have been a number of places to hide. Chinese tech stocks had been beaten down dramatically last year. They're actually up today and up for the year when U.S. markets are down. Digital assets, Bitcoin, one of our favorite assets, up smartly today, about 7%, up positive for the year with the markets down about 10%. So there are places to hide. You just have to look kind of beyond the norm. Gold miners, another great place to hide. GDX, I think, up over 4% today. And gold miners are not only cheap on an absolute basis, but they're also cheap relative to gold. Gold has been stuck being, I guess, manipulated by futures markets for a while. And so we think gold is underpriced, but hard assets, commodity prices, you heard Bob Pisani talking about that. It looks like a time to focus on hard assets as opposed to financial assets.